There is a massive misunderstanding about how wealthy people manage their money. Most people think wealth is about picking the right investments, and that is surface level thinking. The ultra wealthy don't focus on products. What they focus on is Welcome back. I am Dan Thompson. I am a multi-business founder and chartered wealth manager. Today, I want to talk to you about how the ultra wealthy structure their money. Most people think wealth is about picking the right investments, about finding the next big opportunity, accessing exclusive deals of some kind, and that is surface level thinking. And after 15 years of advising high net worth individuals, both across the UK and internationally, I can tell you this: the ultra wealthy don't focus on products. What they focus on is structure. So structure determines things like tax efficiency, risk exposure, liquidity, control, longevity, to name just a few. And if you get the structure wrong, returns won't save you. However, if you get the structure right, average returns compound at an exceptional rate. So the first big shift is that founders build their wealth typically inside their operating companies, inside their trading companies. And this is what comes naturally to them. They don't know any different. Ultra wealthy individuals understand something different, understand something critical. Your business is an income engine. It's not the base for your wealth, because operating companies are exposed to litigation, to market shifts, to regulatory changes, to key person risk, to industry cycles. So what do the wealthy do? They systematically extract capital along the way. They take money off the table along the way, right? And this isn't random, this isn't emotional, this is systematic in approach, because they create things like dividends into holding companies, management fees, intercompany loans, profit sweeps. And why? Because concentration risk is a real issue, a real risk, because having all your money tied up in one company or one asset is never a good idea, because it is the silent killer of founder wealth. And separation, moving your money out of your trading company or operating company structure, reduces fragility. So the wealthy typically build through holding company structures, not through personal chaos. And when you hit a certain level of net worth, a certain level of wealth, typically earlier than most people realize, wealth should rarely be held in your personal name. And you'll see structures such as holding companies, family investment companies, trusts, multi-entity group structures, and not because they're complicated for the sake of it, but because they allow for things like tax optimization or risk compartmentalization or controlled distribution, succession planning, clean exit structuring. And most high earners sadly operate just as individuals, but the ultra wealthy operate as ecosystems. They design capital flow before they design lifestyle. And this next one is where people typically oversimplify, because ultra wealthy portfolios are engineered in layers. So they layer with intent as opposed to emotion, not because it looks good from the outside, but because it creates resilience. So if you take the first layer as an example, that should be based on liquidity. This isn't emergency savings, this is serious liquidity, often 12 to 24 months worth of personal burn rate. And why? Because liquidity buys negotiating power, it buys strategic patience, it buys optionality in downturns, and it buys emotional calm. So layer number 2 is the core growth engine. So this is broad, diversified exposure, things like global equities, strategic allocations, real estate even. And it's boring, it's predictable, it's repeatable, but most importantly, it's normally very reliable. And this layer compounds in the background. So layer 3, strategic concentration. And this is where it gets a little bit more interesting, and you can adopt a satellite approach should you choose. This would include things like private equity, venture capital, direct business stakes maybe, property development, opportunistic allocations, or maybe even crypto. And this is where asymmetric upside exists, but it's never the entire portfolio. Layer number 4, the next layer, optionality capital. So this is dry powder. This is unallocated capital, waiting for market dislocations, waiting for strategic entry points, waiting for acquisitions perhaps. Most people deploy everything, whereas the ultra wealthy preserve a degree of flexibility, a degree of optionality, focusing on defense. So defense should be designed for growth. And the wealthy obsess over defense, over asset protection, not in a fearful way, but in a strategic way, because they'll consider things like legal protection structures, insurance layering, estate planning, cross-border exposure, asset protection planning, or jurisdictional tax efficiency. Once wealth becomes meaningful, someone has accumulated a significant amount of wealth, risk shifts from accumulation to preservation, because most people typically chase upside, right? The wealthy understand that they need to protect downside risk, because when you protect the downside risk properly, effectively, what happens is upside can then quietly compound uninterrupted, because what happens is you can continue to build wealth instead of fighting financial fires or problems. The wealthy think in terms of generations, not tax years. One thing I see repeatedly is the ultra wealthy don't optimize for this tax year. They optimize for the next 30 years. And they ask things like, what happens if I die tomorrow? What happens if I exit my business in the next 5 years? How do I transition wealth efficiently or effectively to the next generation, to my children? And how do I prevent family fragmentation? And what they do is they build things like governance structures, education frameworks, controlled access to capital, or succession clarity. What's really interesting is wealth, if it isn't structured generation, I should say, it's often fragmented as a result, whereas if wealth is structured with intent, it can compound for decades. The ultra wealthy use tax as a strategic lever, not as a reaction. This is underrated so much, this principle, because tax planning isn't about avoiding tax. It's about sequencing, it's about timing, it's about structure. And what the wealthy understand is when to extract, or when to defer, or when to sell, or when to hold, or how to layer income streams effectively, or how to even avoid unnecessary leakage when it comes to their money. And over the next 10, 20, 30 years, small structural tax efficiencies will compound into enormous differences. And tax negligence, however, is what will quietly erode fortunes. Liquidity is power, and this is not just a personal philosophy of my own, but it's also something I've seen with wealthy individuals with huge net worths who sometimes, sadly, feel trapped because they've got everything inside their business, inside their property, inside a liquid investments or locked up investments. And what they don't realize sometimes, or do come to eventually realize, is liquidity creates calmer decision making. It gives you the ability to negotiate better and have leverage. It gives you mobility, a strategic advantage when it comes to allocating capital. And being asset rich and cash poor is fragile. It makes you vulnerable, but the ultra wealthy will rarely let themselves get cornered. Let me leave you with this, because wealth, or building wealth, or protecting wealth even, is all about architecture. The biggest misconception I see is that wealth is built by doing something special. And it's not. It's built by architecting or building something durable. Separation, layering, defense, liquidity, long-term sequencing. The ultra-wealthy don't look smarter. They just look calmer. The reason for this is what they do is they build structure that protects them. And that protection allows compounding to do its job.